The S&P 500 is up about 12.5% year to date. My $100,000 portfolio, up 21%. That's real money, real trades, and a strategy you can learn from. In this video, I'm opening the books and showing you guys everything. How I've structured the account, every major move I made this week, and the risk management habits that keep me ahead of the index. If you run your own portfolio or you're simply curious how other investors approach the markets, you'll walk away with some practical ideas after watching this video. Tactical rebalancing, income from options, and a framework for building long-term wealth. Let's dive in. This entire account started as a $100,000 fund for my newborn son. My goal is to compound it at a roughly 20 to 30% a year over decades. That might sound aggressive, but with the right diversification and a disciplined process, I believe I can achieve it. Originally, I set it up like a classic 60-40 portfolio, stocks and bonds. But quickly, it shifted towards something a little bit closer to a hedge fund mix, a basket of uncorrelated, diversified income streams. The idea is simple. Keep volatility contained while capturing growth across multiple asset classes. That means small caps, US stocks, international equities, long-term bonds, tactical options trades, and even a touch of alternative income funds. My job each week is to keep that machine balanced and opportunistic. So here's where we stand right now. The account value is $120,983. We're down about 0.5% today, but over the last 3 months, we've gained roughly 13,000 or 12%. Year to date, the portfolio is up 21%, handily outperforming the S&P 500's 12.5% gain. Now, I love sharing these numbers not to boast, but to prove that a thoughtful, rule-based approach can outperform the benchmark without living on a trading screen 24/7. Now, what actually drove that performance and what changed this week? So first, rebalancing. After a solid market rally, equities became overweight, so I trimmed the winners and rotated capital into bonds and credit funds. This keeps risk in check and gives me some dry powder if stocks pull back. Second is the options. I actively managed some put spreads on the NASDAQ, QQQ. Earlier, I had held the 565, 525 put spread. As prices climbed, I rolled it higher to a 590, 565 spread. The logic there, if we get a standard correction, the QQQ typically reverts towards its quarterly moving average. That spread captures the downside profit while limiting risk if I'm wrong. Third, profit taking. I trimmed and closed positions in Tempest AI, Tesla, and some other names after strong runs. I've also harvested gains in the nuclear plays SMR, LEU, while still keeping a core stake in many of these positions. On the income side, I added to long-term treasuries, some baby bonds, and a credit opportunity fund, FSCO, that sold off sharply. Exactly the kind of high-yield setup I like when markets get jumpy. And finally, I rolled covered calls and diagonal spreads across names like Rivian, Moderna, and KWeb, generating some option premium that pays me while I wait. So after all that rebalancing, here's the updated mix. We have about 32% small cap US equities, 26% international and emerging markets, 22% fixed income, so long bonds, short bonds, and preferreds, 11% in option strategies, and about 6% in large cap tech, with a small 1 to 2% slice in a Bitcoin high income ETF. This is what an uncorrelated portfolio looks like in practice. No single asset class can drive the whole ship, which is exactly how you reduce drawdowns and keep compounding through market cycles. So let's talk macro for a little bit. My proprietary market monitor, think of this as a traffic light system, just flipped yellow and we are on day 2. Historically, a yellow phase averages about negative 0.35% over 9 trading days, so I'm cautious. The NASDAQ is showing classic topping behavior, choppy intraday action, repeated failures at highs, and waning momentum. We're only about 1.9% off the recent peak, so a standard 5% pullback wouldn't surprise me at all. That's why I'm trimming into strength and holding more bonds and credit funds. When volatility spikes, I'll redeploy that money into equities at better prices. So let's highlight a few key themes and individual names. Here is a look at the weekly performance of all the positions in the account. So my favorite one glance view, and that's what's really moving inside of the portfolio. The bigger squares are bigger positions, smaller squares are smaller positions. So this week, it's a classic split screen, plenty of red, but big bright green squares that kept the overall performance neutral. Top of the leaderboard were the gold and silver miners, with CDE posting double-digit gains and AG close behind it. Precious metals love the softer yield backdrop, and quiet accumulation we've been tracking for weeks has been paying off. So LEU, our standout nuclear name, continued its quiet march higher, adding another impressive leg, even as peers SMR sagged. ELVR, the new Piedmont lithium spinoff, also shined, up strongly on heavy interest in the EV supply chain theme. And so that's a snapshot of the weekly gains, a market of mixed signals, but with enough leadership from hard assets to keep our overall gain year-to-date positive. So we're going to go over some interesting moves on the charts. So the nuclear energy trade. So let's dive deeper into one of the most interesting case studies in the portfolio right now. This is LEU versus SMR, two names in the nuclear space that look similar on the surface but are telling a completely different story once you read the tape. At first glance, both stocks moved almost in lockstep through midsummer. Up until early August, they were practically mirror images, which makes what happened next even more instructive. The divergence begins on August 6th. LEU pushes into fresh highs. SMR, however, failed to follow, even though it had been the leader for months. That's classic Wyckoff theory. A former leader begins lagging while a quieter peer starts to outperform. That's the first sign of distribution. So volume confirmation. From there, pay close attention to the character of each pullback. When SMR slid through its quarterly moving average, the volume dried up dramatically. Low volume declines often look harmless, but in this context, they signal that there's no real demand. No big money is stepping in to support the stock. LEU's pullback, by contrast, were met with surging volume. Each dip attracted committed buying, which tells you that institutions are accumulating shares even as the price retraces. Now, effort versus result. Wyckoff traders talk about comparing effort, or the size of the volume spike, to the result, the price progress that follows. In SMR, we repeatedly see huge volume spikes on up days, but price can't hold those gains. That is heavy supply. Smart money is selling into the strength, letting momentum traders do the lifting and then dumping shares on them. LEU shows the opposite pattern. Moderate volume, steady higher lows, very little give back, small effort, big result. That's quiet accumulation. That's when shares are hard to buy. So the fundamental overlay, technically we are talking about supply and demand, but even the fundamental backdrop supports this divergence. LEU has ongoing chatter about strategic partnerships and buyout rumors, which matches the persistent bid we see in the tape. SMR, meanwhile, is still a great long-term story, but it doesn't have the immediate catalyst. So when momentum fades, there's no fundamental floor. So the trade implications, that's why I've been scaling out of SMR, locking in some gains while it churns sideways, and keeping a core position in LEU. If LEU continues to climb on quiet volume, I'll ride it. If we finally see some true climactic volume spike with no follow-through, I'll know it's time to trim. With SMR, I'm treating every rally as a chance to sell covered calls and reduce exposure. So moving onwards to the next trade that was really good in the portfolio is the precious metals. So miners like CDE and AG continue to grind higher with muted selling pressure. I even rolled my short calls on CDE up from $15 to $20 to stay in the trade. Healthy trend, no need to overthink it. The next trade is lithium. So the global EV buildout remains a long-term driver. I missed part of the rally in some accounts, but I did add to ELVR, a new Piedmont lithium spinoff, which is quietly outperforming. Fundamentals look solid and the chart supports it. And lastly, a currency hedge. I also maintained a small long position in the Japanese yen as a hedge against a surprise dollar reversal. It's been a rough trade so far. The dollar has stayed strong, but I'm selling short-term calls to reduce the cost while keeping a long-term exposure. Here are some takeaway lessons that you can apply right now. So rebalancing works. Selling into strength and buying weakness isn't glamorous, but it's powerful. Trimming after rallies and adding after dips compounds capital and controls risk. Options as income. So covered calls, put spreads, and diagonals create steady cash flow and provide downside protection without guessing market direction. Reading the tape. So volume and price action reveal institutional behavior. The divergence between LEU and SMR was obvious if you watched effort versus reward before any analyst downgrade or news headline. And most importantly, you don't need to be glued to the screen all day. This account typically requires active rebalancing only once a quarter. The rest of the time, it's about sticking to the plan. So that's the full update. Account sits at 120,983, up 21% year to date versus the S&P 500's 12.5%. It's not magic, it's discipline, diversification, tactical hedges, and the willingness to trim when markets get frothy. If you found this helpful, hit that like button, turn it blue. It's free and it really supports the channel. Subscribe if you want to follow along as I keep compounding this account for my son's future. And hey, drop a comment. How are you positioned in your own portfolio right now? What trades or income strategies are working for you and what's not working? Or what did you see in this video that got you curious and you want to ask a question about it? So hey, thanks for watching and I'll see you guys on the next Monday update when I go over all the markets from the S&P 500 to Bitcoin, and also I do a full review of my market monitor. So with that, I'll see you guys later and have a good one.